Most people plan retirement using a simple but deeply flawed assumption. If you earn $100,000 while working, you'll need $100,000 in retirement to maintain the same lifestyle. It sounds reasonable. Same lifestyle, same income, same spending, so the same number should work, right? But the tax system doesn't treat those two situations equally, not even close. Two households can receive the exact same dollar amount in a year and end up with completely different tax bills depending on whether that money comes from wages or retirement sources. This isn't some gray area maneuver, offshore account strategy, or aggressive loophole hunting. This is how the tax framework is actually written. The rules for workers and the rules for retirees operate on different tracks. And once you understand that split, your entire retirement math starts to change. There's a reason many people believe they need an enormous nest egg before they can safely stop working. A lot of retirement messaging focuses on fear. Fear of running out, fear of medical costs, fear of inflation, fear of living too long. Some of those risks are real. But what often gets overlooked is how much lighter the tax load can become once your income shifts away from wages and into retirement streams. When taxes drop, the gross income required to support your lifestyle also drops. That means the total savings target needed to produce that income may be far lower than commonly advertised. Think of income not just as money, but as classified money. A paycheck is one class. Retirement distributions are another. Investment gains are another. Benefit payments are another. Each class flows through the tax formula differently. During your working years, almost every dollar of earned income is exposed, fully visible and largely taxable. In retirement, portions of your income can be partially counted, discounted, offset by expanded deductions, or even taxed at zero depending on how it's sourced and timed. Same cash flow, different tax visibility. Picture two neighbors with identical annual cash coming in. One is still employed full-time and receiving wages. The other is retired and pulling from a mix of benefits, savings accounts, and long-term investments. The worker's income runs through the standard wage pipeline, payroll taxes, ordinary income brackets, limited deductions. The retiree's income runs through a layered filter system, where some portions are only partly counted, some are offset by larger deductions, and some fall into preferential rate zones. The outcome is not a small discount. In many cases, it's a structural reduction. One of the biggest differences starts with payroll taxes tied to employment. While you're working, a slice of every earned dollar is automatically diverted to employment-based tax programs. This applies broadly to wages and self-employment earnings. Once you stop working, that category of tax largely disappears because distributions from retirement accounts and investment gains are not treated as earned wages. The effect is like removing a built-in surcharge that applied to your income for decades. No special application required. It simply no longer applies when the income type changes. Then there's the way benefit programs are counted. Many people assume benefit income is taxed the same way wages are taxed. It isn't. The formula used to determine how much of that benefit income becomes taxable uses a blended calculation that often results in only a portion being exposed to tax. Depending on what other income sources you have and how they're structured, a meaningful share of those benefits may never enter the taxable column at all. You still receive and spend the money, but the tax formula doesn't treat every dollar equally. This partial counting effect creates planning opportunities. When only a fraction of one income stream is included in taxable totals, your reported taxable income can appear much lower than your actual lifestyle cash flow. That lower taxable number then influences which tax brackets apply, which credits phase in or out, and which preferential rates you qualify for on investment gains. The system is interconnected. Reduce the counted income in one area, and several other calculations shift in your favor. Deductions also evolve with age. The baseline deduction available to taxpayers increases once you cross certain age thresholds. That means a larger portion of your income can be automatically shielded before any tax rates are applied. You don't need exotic itemization strategies to benefit. The expanded deduction is built into the structure. For many retirees, this alone can wipe out a substantial slice of otherwise taxable distributions each year. Investment income adds another layer. Long-term investment gains are taxed under a separate rate schedule from ordinary wage income. When your taxable income, after deductions and partial benefit inclusion, falls under certain thresholds, those gains can qualify for the lowest available rate band. With careful withdrawal sequencing, it's possible to realize investment gains while staying inside that favorable band. That means assets can be sold to fund spending with minimal or even zero federal tax impact under qualifying conditions. All of this leads to a counterintuitive outcome. Retirement income often travels through a more forgiving tax path than wage income. The system is designed to avoid overtaxing people who are no longer earning paychecks and are instead drawing from accumulated resources. Whether that design came from social policy goals or political incentives is a separate debate, but the mechanical result is clear. The same headline income number does not produce the same tax result across life stages. That drop translates directly into a smaller required portfolio to generate the needed income. A lower income target means a lower asset target under any reasonable withdrawal framework. And a lower asset target can mean fewer years in the workforce, less pressure to chase risky returns, and more flexibility in how and when you step away from full-time employment. The surprising part isn't that special cases exist. The surprising part is how often these outcomes appear when income is diversified across retirement. Sources and withdrawals are sequenced intelligently. This is not edge case engineering. It's mainstream tax treatment applied with awareness. In the next section, we'll walk step by step through how different retirement income sources are counted, how deduction layering works in practice, and how two households with identical cash flow can end up with radically different final tax bills, all within standard rules. To really understand how powerful this shift can be, you have to stop thinking about retirement income as one single stream and start seeing it as a set of adjustable valves. Each valve releases a different type of income, and each type passes through a different tax filter. During your working years, most of your money comes through one wide pipe, wages. The pipe is heavily monitored and fully taxable under ordinary rules. In retirement, you're no longer forced to use just one pipe. You can open and close multiple channels: benefit payments, pre-tax account withdrawals, after-tax investments, tax-free buckets. And the mix you choose each year changes the tax outcome. Let's start with benefit-style income sources. These programs use a layered inclusion formula instead of automatic full exposure. The calculation blends your other income with a fraction of your benefits to decide how much becomes taxable. Because only part of the benefit is counted in that formula, retirees with moderate additional income often find that a significant share of their benefit payments never gets taxed at all. The key insight is that the formula is sensitive to how much other taxable income you show. Control the surrounding income, and you influence how much of the benefit becomes visible to the tax system. Next, look at withdrawals from pre-tax retirement accounts. Yes, those withdrawals are generally treated as ordinary income, but what matters is the bracket they land in after deductions and partial exclusions are applied. If your deductions are larger and your counted benefit income is smaller, those withdrawals may sit in lower brackets than you expected. The same distribution amount can produce very different tax due depending on what else is happening on the return that year. Retirement planning isn't only about how much you withdraw, it's about what else you withdraw alongside it. Now add taxable investment accounts to the picture. These accounts generate income in multiple forms: dividends, interest, and realized long-term gains. Long-term gains especially receive special rate, treatment separate from ordinary income brackets. The rate you pay depends on your taxable income after deductions. That means careful sequencing, choosing which assets to sell and when, can keep gains inside the most favorable band. Instead of avoiding gains entirely, retirees can sometimes realize gains deliberately while staying inside low or even zero rate zones, replenishing cash without increasing tax burden the way wages would have. This creates a concept professionals sometimes call income layering. Imagine stacking transparent sheets. Each sheet is one income type. Some sheets are fully opaque to tax, some partially transparent, some nearly invisible. Your total lifestyle spending equals the full stack, but the taxable portion is only what shows through after deductions and special treatments are applied. Two stacks with the same height can cast very different tax shadows depending on which sheets are used. Deductions play a bigger role here than many people expect. Once you cross certain age thresholds, your automatic deduction increases. That larger deduction acts like a buffer zone that absorbs income before tax rates apply. Think of it as a tax-free allowance that grows later in life. When combined with partially counted benefits, this buffer can offset a meaningful portion of retirement withdrawals. Many retirees find that their first block of income each year effectively lands inside this shielded zone. Credits and thresholds also behave differently at lower taxable income levels. Various phase-outs that reduce tax benefits for higher earners may no longer apply once your counted income drops. That can restore eligibility for certain advantages that were unavailable during peak earning years. Again, the theme is not special tricks. It's that the formula responds to lower taxable income with more favorable treatment across multiple lines. Another overlooked factor is timing flexibility. Workers are paid on schedules they don't control. Retirees often control when they realize income. You can choose which year to sell an asset, which year to convert funds between account types, which year to delay or accelerate certain withdrawals. That timing control lets you smooth income across years instead of spiking it. Smoother taxable income usually means more efficient tax outcomes because you avoid pushing large amounts into higher brackets all at once. Consider a simple comparison scenario. A working household receives steady wages every month, all fully exposed to payroll and income tax rules. A retired household might draw part of their spending from benefits, part from savings withdrawals, part from long-term investments, and part from previously taxed principal. The working household has limited flexibility and full exposure. The retired household has flexibility and mixed exposure. Same lifestyle spending, different tax engineering, possibilities. This flexibility also allows something called bracket management. Instead of ignoring tax brackets, retirees can intentionally fill lower brackets each year with planned withdrawals, then stop before crossing into higher territory. It's like pouring water into measured containers rather than dumping it all into one. By managing how full each bracket gets annually, lifetime tax paid across retirement can be reduced without changing total spending. There's also the idea of tax diversification, spreading your lifetime, savings across differently taxed account types. Pre-tax, after-tax, and tax-free buckets each behave differently when tapped. If all your money sits in one type, you lose flexibility. If it's diversified across types, you can choose which bucket to draw from depending on that year's tax picture. This isn't about predicting future tax rates perfectly. It's about preserving options, so you're never forced into the worst-case withdrawal path. A common mistake people make is projecting retirement using only one account type in their model. They assume every dollar withdrawn will be taxed the same way. Real retirement cash flow is rarely that uniform. When multiple account types are used together, the blended tax rate is often much lower than the marginal rate people fear while working. That blended rate is what determines how much gross income you truly need. Psychologically, this is hard for many savers to accept because they've been conditioned to think in gross numbers. Salary is quoted in gross. Savings targets are quoted in gross. Investment returns are projected in gross. But lifestyle is funded by net, what you actually keep after tax. Retirement planning that ignores the net versus gross. Shift can overshoot by a wide margin. This doesn't mean everyone will automatically pay very low taxes in retirement. High spenders with large forced distributions and heavy interest income can still face meaningful tax bills. But it does mean the baseline assumption that retirement income is taxed like salary is often wrong. And when a core assumption is wrong, every downstream calculation built on it becomes distorted. The more accurate approach is to reverse the process, start with desired after-tax spending, model retirement tax treatment by income type, then solve for the gross amount required. When people run that version of the math, the answer frequently comes in lower than expected, sometimes slightly lower, sometimes enough to move a retirement date forward by years. In the next part, we'll walk through detailed numeric style scenarios, show how sequencing withdrawals change outcomes, and break down how miscalculating taxes leads people to set unnecessarily high savings targets and unnecessary stress. Let's make this practical by walking through structured scenarios, because abstract rules are useful, but numbers make the impact real. Imagine two households that both need the same lifestyle spending level each year. Their grocery bills, housing costs, travel plans, and daily living expenses are nearly identical. From the outside, their financial lives look the same. But one household is earning wages, and the other is funding life from retirement sources. The difference in tax treatment between those two situations can reshape how much money must be generated. In the first place, start with the working household. Their income arrives as wages or self-employment earnings. Every dollar is classified as earned income. Before they even see the money, employment-based taxes apply. Then ordinary income tax brackets apply. Their deduction offsets part of it, but the remainder flows straight through the rate schedule. There's very little flexibility in timing. Paychecks arrive on a schedule, and taxes follow automatically. Even if they invest on the side, their primary income stream is rigid and fully exposed. Now compare that with a retired household funding expenses from a blend of sources. Their annual spending need might be, say, the same as the worker's take-home pay, but the way they assemble that spending money is modular. They might receive benefit payments monthly, draw a planned amount from a pre-tax account, sell some long-held investments, and use a slice of already taxed principal from savings. Each of those components has a different tax character. When combined thoughtfully, the reported taxable income can land far below the actual cash available for spending. Sequencing becomes the strategy lever. Which dollars do you spend first? Which accounts do you tap in the early years versus later years? For example, drawing only from pre-tax accounts every year can create unnecessary taxable spikes. But blending smaller pre-tax, withdrawals with investment, gains, and partially counted benefits can keep taxable totals inside more favorable zones. Good sequencing is less about clever tricks and more about avoiding blunt, one-source withdrawals. Another planning dimension is multi-year smoothing. Taxes are calculated annually, but retirement lasts decades. Instead of optimizing each year in isolation, smarter planning looks across a 5, 10, or 20-year window. Some years, you may choose to realize a bit more income while your brackets are low. Other years, you may deliberately keep income lighter. This smoothing approach can lower lifetime taxes. Even if a few individual years show slightly higher tax than the absolute minimum, it's a long game optimization. Market behavior also interacts with the system. In down markets, selling assets may produce smaller gains or even losses. Those years can be used to rebalance portfolios, harvest losses, or realize gains at reduced levels, all while staying within favorable tax bands. Let's talk about behavioral impact. When people overestimate how much gross retirement income they'll need, they tend to respond in predictable ways. They delay retirement unnecessarily, take excessive investment risk, chasing higher returns, or lock too much money into inflexible products out of fear. Overestimation doesn't just change spreadsheets, it changes life decisions. It can postpone career exits, travel plans, family time, and health-focused lifestyle changes that are easier earlier than later. On the other hand, underestimating needs is also dangerous, which is why the goal is not optimism, it's accuracy. Accurate planning recognizes healthcare variability, inflation uncertainty and longevity risk, while also recognizing tax structure differences. Balanced modeling removes exaggeration on both sides. It neither promises effortless retirement nor assumes worst-case taxation forever. Advisory incentives are worth understanding here. Many professionals provide real value, but compensation structures differ. Some are paid for planning work directly. Others are paid based on assets managed or products used. Those differences can subtly influence which risks get emphasized most strongly. A planning model that produces a lower required asset target may receive more pushback in some environments than in others. That doesn't make the math wrong, it just means incentives should be transparent. Fear-based planning messages tend to travel further than nuance. You'll need far more than you think, spreads faster than you're required. Gross income may be lower after tax modeling, but nuanced truth is more useful than dramatic headlines. Retirement is not funded by gross income, it's funded by spendable income. That distinction deserves center stage in every serious plan. Another critical factor is legislative change risk. Tax rules do evolve. Thresholds adjust, deductions rise and fall. Planning should include flexibility in case rules shift over time. That's another reason tax diversification across account types matters. It protects you from being fully exposed to one rule set. Flexibility is resilience in financial form. Technology has made modeling easier than ever. Today, scenario software and projection tools can simulate different withdrawal mixes and timing choices, but tools are only as good as their assumptions. If the assumption is retirement income is taxed like wages, the output will skew high. If the assumption reflects mixed source retirement taxation, outputs become more realistic. The result of all this is not a promise of ultra-low taxes for everyone. The result is awareness that the tax code treats life stages differently, and that retirement income engineering is a legitimate, rule-based planning discipline. When understood and applied, it can reduce required gross income, lower lifetime taxes, and expand personal choice about when work becomes optional.